So as a financial planner, I deal a lot with retirement accounts. Now, most people know that age 59 and a half, that's that magical age when you can take money out of a retirement account without any kind of 10% early withdrawal penalty. And so there's a few exceptions to that. Unreimbursed medical expenses, disability, higher education expenses like college, and there may be a few others, but there's another thing called 72T payments, or substantially equal periodic payments. And so basically that's a way to avoid the 10% penalty, but there's a catch to it. You actually have to set up a payment stream for the greater of 5 years or 59 and a half, and there's no penalty on that. And so we're going to dive into the exact definition of that and how it works, how do you calculate it, etc. I want to mention to you that I'm not a tax advisor. I'm a financial planner, and you should not do something like this unless you've actually talked to a professional tax advisor just to make sure that's appropriate for you. So what 72T payments are, basically that's where you can set up a payment stream, like I mentioned, for the greater of 5 years or 59 and a half. And so I think the idea behind it is that, the IRS will allow you to, waive that penalty if you'll commit to going, seeing through this stream of payments for 5 years that generates taxable income. So maybe that's a fair trade-off. I don't know the idea behind it, but anyway, it is what it is. So let's look at the actual definition of it. So substantially equal periodic payments, and I won't read this word for word, to avoid a 10% early withdrawal penalty, you set up a stream of payments and it must last for 5 years or until you're 59 and a half, whichever's longer. So again, 5 years or 59 and a half, whichever's longer. So if I was 40 and I set these up, I'd have to set these up for almost 20 years. If I was 55, basically I have to set it up till I'm age 60. If I set it up at age 57, I'd have to see that through till age 62. So it's 5 years or 59 and a half, whichever's greater. There's actually, it's not as simple as saying, hey, send me a check for $5,000 a month. No, you can't just do that. There has to be a calculation method behind it. So there's actually 3 different methods of calculating this. There's the RMD method, there's the amortization method, and the annuitization method. Now, in my experience, most people that are even looking at doing a 72T income stream, they just want to know what's the maximum payment I can get for the balance of my IRA. So I'm going to just focus on the amortization method today because that's really what generates the highest amount of income. So how do you actually calculate this? Well, I'll show you. You could probably Google, search online for, different 72T calculators. There's one I use at bankrate.com. I'm not vouching for the accuracy of the information at all, but it's a pretty widely used 72T calculator, and it works good. So I think you can see here the different fields. There's an account balance field, reasonable interest rate field. What is a reasonable interest rate? We'll talk more about that. Your age, beneficiary, we'll use a single life expectancy table. That generates the most income typically, so we'll just kind of focus on that. So again, what is this reasonable interest rate? Okay, so let's look at the definition of this. So what the IRS says is that a reasonable interest rate is an interest rate that is not more than 120% of the federal midterm rate for either of the 2 months immediately preceding the month in which the distribution begins. What the heck is that? Okay, I'll explain it to you. So these federal midterm rates, they're published every month, okay? And so you can use 120% of the highest rate that you see for either the previous 2 months. So if I wanted to start payments in September, I would look back at August and July and see what those rates were. So let's actually look at the most recent published rates. So this is actually a table I found where it shows you, so if I wanted the payments to start in September, I could look back at August and July. Now clearly August is the higher of the two, and so I could use that 3.73 to be used in my calculation. Now you'll notice that rates have recently been coming up. For a long time, they were very, very low. You look back at January and February, 1.55, 1.67, and that's what you could use in your 72T calculation. So let's go back to that calculator. And so you'll see there that based on my IRA balance of $1 million, if I plugged in 3.73, So that would allow me to take out about $56,000 for the year. And I'd have to see that through, again, 5 years or 59 and a half. Okay? So that is, it is what it is. It's been a lot worse, as far as rates go. It's actually gotten a little bit better because interest rates have been slowly coming up. But what if that really didn't meet my needs? So the IRS has actually changed the rules. They changed it, I believe, in the first part of the year of 2022. So let's look at the new definition. So the interest rate that may be used is not, it can't be more than greater of 5% or 120% of the federal midterm rate. So we already saw the federal midterm rate. The best we could do there is 3.73. I could actually use 5%. Okay, they changed the rules. They said you can either use 5% or 120% of the federal midterm rate, whichever is greater, the previous 2 months before you begin your distribution. So let's go back to the calculator and let's plug in 5%. As you can see here, now what a dramatic difference. I could take out $65,000 and there's no penalty for that. And I just continue that payment stream for 5 years or 59 and a half. Well, so what if I was 55 and I was taking these distributions? So, even for retirees, a good rule of thumb is maybe 3 or 4%. It just depends on who you talk to about that. That's a 6.5% distribution. That's pretty substantial, assuming that's your only asset. And so just because you can take it out doesn't mean you should take it out. So I'll leave that where it is. But so let's say that I didn't need that much money. $65,000 is a lot of money to take out based on my $1 million account balance. What if I needed, let's say, $4,000 a month? And that would do me just fine, and I'd see that out for 5 years or 59 and a half, whichever is greater. So what if I just needed $48,000? So the thing about 72T payments is that, let's say I didn't fulfill that. Okay, let's say I'm going along, I'm in year 3, and I decide, hey, I want to modify this. I can't do that. What if I want to take some extra money out of my IRA? I can't do that. Well, actually, you could, but then you'd be retroactively penalized for all those distributions you've been taking out so far. The 10% penalty would apply to that. So do you really want to do that? But what if you had an emergency and you just had to take some money out? Well, that's something to consider if you're doing 72T payments. So I'll show you what a lot of people will do. Let's say I needed that $4,000 a month. And so out of my $1 million IRA, I'm sending $48,000 to my bank. So that $1 million is basically tied up because I'm committed to this payment stream. So what a lot of people will do is they'll figure out, hey, how much of my account balance does it really take to get me what I need? And so I'm dealing with some round numbers here for this example, but if I got it down to $750, that would get me about $49,000. I needed about $48,000, so that would work. And so if I had a $750,000 IRA, that would generate what I need. So what a lot of people will do is maybe they'll split their IRA. So you can have as many IRAs as you want. So you can take that $1 million IRA and you can split it into two. You can say, I'm going to put $750 in one of them, $250 in another. I'm going to send my $48,000 to the bank out of the $750 IRA, and then the $250, it has nothing to do with my 72T payments. So what if I at some point needed to grab at $10,000? Well, I could do that from my $250 IRA without messing up the 72T stream I have going with the $750 IRA. Okay? So that would work pretty good. I mean, what if I started a little bit later, like age 57? And if I had everything in one IRA, I can't deviate from that payment stream until I'm 62, according to the rules. So if I had this separate IRA I hear, hey, once I'm 59 and a half, all bets are off, I can do whatever I want to. And so if you need a little bit extra cash, you could take it out of that smaller IRA. So a lot of people will do this. They'll figure out, hey, what's the minimum balance I need to generate the income that I do need, and then they'll split that off to give themselves a little bit of flexibility. So how is this reported? How do I get a waiver of the penalty? And so who do I need to notify about this? So whoever you have your IRA with, whatever custodian it is, they're going to send you a 1099-R form in the following year, usually January, February. And so the 1099-R form, it's going to, box one, how much did you take out during the year? How much of that was taxable? That's going to, those two numbers will be equal there. How much taxes withheld? I can withhold tax from an IRA distribution. How much did you withhold? If there's a state tax that's applicable, it'll show you that as well. Now, box 7, it's going to have a distribution code. Okay, so with that distribution code, it's going to have a number in it. Let me show you the codes. So number 1 is early distribution, no known exception. That's probably what it's going to be on your 1099-R in most cases. It would be nice if they could put a code 2 in there, early distribution exception applies, like the exception is I'm taking these SEPP payments out. But most likely they don't want to be on the hook saying, hey, these are penalty free. I don't think they want to make a statement about that. That's at least my guess. So they're probably going to code that code 1, and that's okay. And so when you go to file your taxes, that's when you explain that, hey, these were substantially equal periodic payments, and you're committed to this payment stream, and that's when the penalty will be waived. So I hope this video is helpful, just learning about what we call 72T payments or SEPP payments, substantially equal periodic payments. It can be complicated. You want to do it the right way. You don't want to mess it up. Please talk to a tax advisor and somebody that knows what they're talking about before you set up a payment stream like this, because you don't want any surprises down the road, and you certainly don't want to be retroactively penalized on these distributions. So if I can answer any questions, my contact information is in the About section of my YouTube channel. Please reach out anytime, and thanks for watching my video.